sample exam questions. Now, when I show the exam questions, absolutely no photo taking. And after the midterm exam, there'll be one session, absolutely no photo taking. Okay? Basically, I want you to convert the text from the lecture note into, let's say, table of numbers by yourself. Right? Because what I show on the slides will be sort of, like income statement format, example, right? Income statement like or income statement type format. Okay, for the example, one of the examples, but I don't show that in the text. So you're going to have to read text, see the information, and format the information by yourself. I don't allow photo taking. Okay, that's deliberate. Okay. This one will be much better because it's 15 minutes. It sounds more reasonable than 10 minutes. That's why Champuri didn't do it quite well much. Okay. Did we meet last week? Yeah. I'm thirsty. I'm thirsty as well. Okay. We saw financing choices, right? Various. Okay. And different choices basically suit different firms or firms facing various constraints in different ways. Okay. And we left last week with the question of whether there would be a financing choice or mix, okay, or certain terms and conditions in the securities contract that would minimize the cost of capital, okay, and if yes, would that choice or financing mix vary across firms? Okay, so basically to turn this issues or questions into a question that faces practitioners day in, day out, we could say, well, suppose we are CEO or we are a team, right? We work in the finance section of a firm, okay, and we have to think about the debt equity mix or leverage that is appropriate for our firm. How could we know that? How could we know what is appropriate for our firm? What's appropriate for our firm? Debt equity mix. Not too high, not too low, yeah. Somewhere that is in moderation, yeah, but where is that? For some firms, for example, if our firms are growth firms, obviously, as we discussed last week, very little leverage, if any, would be optimal. Okay, 30% leverage, that's likely to be a bit too high, right? Because if we are growth firms, okay, the value of our firm is basically characterized or derives from growth options. That's why we are a risky firm, okay, being growth firm. Then we don't want any fixed obligations in our operation because the prospects are still very uncertain. Okay, so how would we know? How can we figure out how much debt to use? Let's say we have a marginal project, a new project. Okay, how much debt, how much equity should we use? We need additional financing, money to come from outside. Right? Okay, we know that for sure. And the project is big, so it has economic significance. A lot of debt, or half, or what? How do we know? So let's start from somewhere simple, very, very simple. Okay. So why would we want to start from somewhere simple? So that we get to some place. Right? If we start with a lot of complexity, we'll never get started. Right? We never get to go anywhere. Because we'll be asking, what about this? What about that? What about that factor, this factor? How about if you want to go from A to B, use a map that tells only the direction. All right, go straight. Okay, keep on going straight on the main road for about 5 kilometers and then turn right. Right, stay on the main road. Instead of the road, be careful, the road is going to go left, right, off to the right a bit. There's a little bend there, uphill, downhill, go through several communities and so on. Instead of that, just keep going straight, basically stay on the main road for 5 kilometers and then turn right. Okay. So in this session here, hopefully before the break, our break, you get to see all of the theoretical argument that financing choice does not matter. Does not matter to our wealth. You see that. Okay. Now, before moving ahead, if I said here, we also looked at the possibility last week, the possibility of financing choice that maximizes firm value may vary across firms. Instead of saying this, I said, instead of minimizes the cost of capital, I say maximizes firm value. What sort of picture would you draw? Sorry?
The cheapest option, basically the one that costs the least money. As in the financing choice that costs
Yeah.
the least.
Okay, yes, that's right, that's what this means. But if I said, instead of saying minimizes cost of capital, I say maximizes firm value. What would be the link between the two? How would you show systematic, the link between minimizing and maximizing? Maximizing cost of capital and maximizing firm value. In a systematic fashion, one sentence. One sentence. You need this kind of skills to talk to your boss. You work in finance, to talk to your clients. Okay. See a link? You can think of a link in a systematic fashion. I was asked this question before when I was sitting there, and so basically, we were taught if you feel blank, right? If you feel blank, in the middle of nowhere, we have to start from what we know, whatever it is. So we think it's relevant, and we know it, and take it from there, right? It may be a wrong start. Okay, it could be a bad start, but at least we get to start. If it is a bad start, we start, right? Proceed a bit, and yeah, people know it's a bad start. That's fine. So we come back and take another route. Okay. But we don't sit and do nothing and feel no. Okay. What do I know? As you would notice, okay, and in this course, undergrad course, PhD course, or in the corporate finance course next term, you see one thing in common across all the courses that I teach. And that one thing in common is that I know only one formula in finance. This is the only formula I know in finance. When it is equity valuation, I start from here. Fixed claim valuation, that's really a piece of cake. Piece of cake. Easier, much more straightforward. I also start from here. Okay. Financing choice that minimizes the cost of capital is to minimize the R here, right? The discount rate. And as you see, this is basically capitalization. Okay. What would be the link between this, minimizing the cost of capital and maximizing firm value? We minimize this, all this constant. Yeah, maximizes this. That's the link. That's the link. Okay. Why am I asking this seemingly pointless question? I don't think it's pointless. Okay, you need to be able to think about round trip. Okay, think of a round trip. And thinking of a round trip rather than just one leg is very important, right? Especially those who want to live in a stock market, want to trade, okay, want to buy and sell, want to speculate. Once you take position, you need to close your position. Okay. Once you buy, in general, assuming short sale constraints, once you buy, okay, buy and so what? You're gonna keep recording paper gain? No, you're gonna have to report cash at some stage. Okay. So you need to think about round trip. Okay. Let's carry on to Modigliani and start with Modigliani and Miller, capital structure irrelevance theorem. Okay, in this Nobel winning work of paper or papers, right? In the main, just 1950. Okay, Modigliani and Miller basically said that look, the market value of any firm. Market value of any firm. What does it look like? Market value of any firm. What value is it? Value of debt or value of equity? Debt or equity? Equity. Okay. Is independent of its capital structure. The market value. Okay. Let's say. Left-hand side is assets. This is debt, this is equity. Okay? Right. Let's define firm in terms of market value. Independent of its capital structure, so it means that regardless of the capital structure, the value of equity remains the same. If we increase debt, how could equity remain the same? The market value of equity is going to come down. Only constant the left-hand side of the balance sheet. So, when you read papers, okay, or I'm not sure about the practitioners or the industry, depends on the sophistication of the practitioners you talk to. When we see something like this, we see the term firm value or market value. That's the market value or the value of the left-hand side of the balance sheet. Okay. Otherwise, people will say market cap or market value of equity. If they say firm value, it has to be the value of the left-hand side of the balance sheet. All right. And in this case, it's the value of the left-hand side of the balance sheet. Okay. To which capital structure is irrelevant. Okay. In other words, two identical firms, right? Two identical firms will have the same total market value of the left-hand side of the balance sheet, even if they have different leverage. Or the same firm, right? And they simply, it simply changes its leverage ratio. Its market value will remain the same. Okay, this is the argument. In other words, leverage does not matter to valuation. In other words, once again, leverage does not matter to shareholders' wealth, as we will see. Okay. All right. this irrelevance will hold, Modigliani and Miller said, as long as we have all these 9 assumptions, core conditions. But do we need to remember all? I'll examine you on these assumptions. But do we need to remember all? Let's see. Okay. First one, frictionless capital market. And this paper sets a very, well, one of the first papers actually that sets the definition for frictionless or perfect capital market. Okay. Now, if you talk to sophisticated practitioners, let's say, and you say to them, you're putting forward some sort of argument to them, okay, and you say, assuming perfect markets, we should see this, whatever going on, right? That person could ask you back, what do you mean by perfect market? What do you mean? And if you said, in the Modigliani and Miller 1958 sense, that person will understand. Okay? Because the definition here is a very strict definition of a perfect market. And a lot of people who want to, scream out perfect markets, they will basically adopt this definition. Okay? Frictionless capital market or perfect market. No frictions at all. Right? We talked a little bit about perfect market, right? At the start of the course. Perfect information. Everybody know what everybody else intends to do, or everybody else's incentives. Okay, that's first assumption. Second, individuals can borrow and lend at a risk-free rate. Do we need to memorize this? Do we? No, we don't. This is the same as in the Fisher separation theorem, right? Yeah? Go to the stock market to borrow and lend, to make transactions at the market determined rate of interest. Okay? And in the word of Fisher separation theorem, certainty is assumed. So if there's no uncertainty, then time value of money is basically risk-free rate of return. Okay, a return on risk-free asset. Right? And the discounting, if you like, right, the risk-free rate in the analysis of Fisher separation theorem tells us or gives us actually the basis for using time value of money in valuation. Okay. So the idea of using, money, time has value of money, right? That is, time has value of money comes from Fisher separation theory. Okay, and that's practice. This is another example of practice, right? Derived from theory. Okay. No bankruptcy costs. Do we need to say this? Frictionless capital market. This goes without saying. This goes without saying. But of course, the 1958 paper does not lay out all these assumptions right down on the table like this. I got this from a textbook. Really nice, really lovely. Although, yeah, we don't need to say assumption 2 or assumption 3. We just say perfect market. But for illustrative purposes, it's nice to see. And yet, as we go through examples, we'll see that one assumption is missing here. But that is, we don't need to spell out that assumption. You will see. Okay. Firms issue only risk-free debt and risky equity. Has this assumption got to do with perfect market? In part, that is ability to issue risk-free debt. Right? Equity is risky. Yeah, that's fine. We have uncertainty. Right? We can have uncertainty in a perfect market. But why are firms required to issue or assume to issue only risk-free debt? Because we want to see the idea here, right? What Modigliani and Miller want to prove is
changing or change, right, in the amount of debt does not matter. Amount of leverage does not matter. Not the change in the risk of debt, not change in financial risk. So in this case, let's hold the risk of debt constant. And one way to do this is to assume that firm issues only, say, the AAA bond, but that's fine. But that would involve extra lines for risk adjustment. And we end up with the same, let's say, same conclusion. So without loss of generality, just assume that firms issue only risk-free debt, holding the risk of debt constant. Right, that's it. Okay, why does this make sense? Because we're not interested in the effect of default risk or the risk of the debt associated with debt issues. We're interested in, or they are interested in, the effect of the size of debt, the amount of debt in the capital structure. A lot of debt or not so much debt. Okay?
Same. We're not interested in the effect of systematic risk. So let's hold constant systematic risk. Okay? In the papers they say, let's assume that all firms belong to the same risk class K, or K risk class. And I think this is why a lot of textbooks, when they write down discount rate, they use K. It comes on this page, I think. Nobody told me, but this is something that is. Okay, firm can pay tax, but investors do not pay tax. Firm can, but we can assume that at the start, as you see, Modigliani and Miller will assume no corporate tax. Okay? Yes, this no personal taxes is a clear product of assumption one, perfect market. Okay. So we could say assumption 6, rephrase assumption 6 and say, well, look, perfect market, but we can allow firms to pay tax. But investors still pay no tax, no personal taxes, okay, no tax at all. Either income tax or capital gain tax, no tax, right, for individual investors. And let's assume, let's hold constant growth. So our cash flow streams are perpetuities, that is, we assume zero growth. Okay, not that firm go down, right, but firms don't grow, stay at the same level. No growth, zero growth, not negative growth. Okay? No asymmetry, no signaling opportunity, no moral hazard. Do we need to say, spell out these two assumptions? No, when we say perfect market, that goes without saying. No adverse selection, no moral hazard. Okay, so based on these 9 assumptions, Modigliani and Miller basically claim that, look, in a perfect market, investors can create homemade leverage. They can borrow on their own. Well, yes. You see, individuals can borrow and lend at the risk-free rate. Right? That's an assumption. But look, if you say perfect market, this comes automatically. And with the possibility of feasibility, perfect feasibility of homemade leverage, individual investors can borrow and lend on their personal account in the same way as firms can. Because of this, the value of a levered firm will be identical to the value of an unlevered firm if we assume no corporate tax. And this equation 1 is known as Modigliani and Miller proposition 1. And this equation is one of the most difficult equation to prove in finance. Okay, and Modigliani and Miller, of course, use the arbitrage argument to prove this equation. Okay, so in other words, the market value of a firm, right? Proposition 1 says this: the market value of a firm has nothing to do with its capital structure, but the market value of the firm is given by capitalizing the expected return the firm's assets generate, okay, or the return the firm's assets are expected to generate, capitalized at the capitalization rate rho appropriate to the firm's risk class. Okay. So market value of a firm is given by this. And it has nothing to do, this is rho. We'll come back to this. This is very important. Is particularly Miller called this rate capitalization rate. And this is how it should be called, rather than the discount rate. To me, I always wonder what does it mean discount? Making the amount smaller, right? In discount. But does it lose value? No. It just adjusting for time value of money. So this is flow, right? This is a flow variable. Return from income statement. Let's say income statement is a flow variable. The variables in income statement are flow variables, right? The engineer probably understand this more than business school students. Income statement, we will see for year ended. For the year ended. Balance sheet is a level. Balance sheet variables are level variable because as at. Okay, as at and then date. Right? So this is a process of converting a flow variable into a level variable. Right? Period cash flows. Right? Convert that into value at this point in time. This is the value of our firm. Okay? So periodic cash flows, expected future cash flows, that is, get capitalized into an amount of capital. Okay, so this is called capitalization rate rho, and in this case, this capitalization rate rho appropriate to risk class. Right? Nowadays, in the business school type textbook, they call risk-adjusted discount. Right? But I prefer capitalization rate appropriate to risk class. Okay. Now, to I prove for equation 1, once again, Mandibular and Miller employ an arbitrage pricing argument. Okay, that is two identical assets must have the same price. Right? Otherwise you have disequilibrium. Okay, and in a perfect market there'll be arbitrage, and then value or price of the two assets will revert back to become identical. Okay, so in table 1 we will see the detail for unlevered firm and a levered firm. Unlevered U, subscript U, levered L, right? So two firms in the same risk class, you can say that they have the same net operating income. And we'll see the value, what the value should be in equilibrium. Okay? All right, the left-hand side, no debt, unlevered co. Let's call it by this name. Okay, I use this example for the undergrad students as well. Okay, and hammer them with master's degree material. Yeah. Okay, so net operating income, say 10,000, right? No debt, of course, no interest expense. Net income is 10. Okay, let's talk to Adam Smith. In this case, there's no debt in the firm. So what should be the market value of equity of the firm? Let's suppose Adam Smith invisible hand say in equilibrium, well, the market value of unlevered firm should be 1 million. Okay, so in this case, then the implied cost of equity is 10%. 100,000 divided by this. Okay, what about rho? Capitalization rate appropriate to risk class. 100,000 here the same, right? Divided by 1 million here, but this one, right? Okay, no debt, so the market value of equity becomes the market value of the left-hand side of the balance sheet. It's the same, right? Because there's no debt. Now, what if unlevered co becomes levered co? Same NOI, same systematic risk, same risk class, same NOI. Otherwise identical firm except with respect to leverage. Let's say Unlevered borrows 50% leverage. That is, increases its leverage from 0 to 50%. So its equity goes down to 500. Okay, if debt is 500. Okay, so in this case then, the interest expense becomes 30,000, 6% on 500. Okay, 500,000. Net income 70. So the implied cost of equity is 14. 70 divided by 500. Okay. What about the market value of the firm? Should be 1 million, right? 500 plus 500. Okay. And since the firm still belongs to the same risk class, okay, rho has to be still the same, has to, right? Has to be the same still, 10%, because this is the risk class of the firm's assets. And those two firms belong to the same risk class, right? So risk class hasn't changed yet. Okay, so it has to be 10%. Okay, and it's still 10%. 100,000 divided by this. Still get 10%. Okay, or if we capitalize this by 10%, we get the same thing, 1 million. Okay, so these are the equilibrium conditions. Okay. Are you okay so far? If you're okay so far, I want a break to myself. I forgot something downstairs, right? I'm leaving something running, right? I forgot to change on my computer. Try to make sense out of this. No more than 10 minutes, I'll come up. Okay, no more than 10 minutes. Sorry about this.